Clap along if you feel like a room without a roof. Clap along if you feel like happiness is the truth. Clap along if you know what happiness is to you. Clap along if you feel like that's what you want to do. Clap along if you feel.
You know why they're so happy, Al, is that they are paying a lot less money in tax than they should
I
be
suppose.
because they are tax-sensitive investors.
I like watching happy people. Makes me happy.
It does.
Makes me happy.
It really kind of annoys me.
Not me. I mean, I know that's me in a few years.
Yeah, that's
and you even a few more years after
that.
That
could be you next year.
I don't think so.
That could be you next year.
I don't think so.
Welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. This is Big Al Clopine. Thanks for tuning in. Talking tax planning, it's close to end of year. There's a lot of things that you should be taking a look at when it comes to your overall taxes, and that's what we're getting into today. But before we dive into more detail, let's go to the true-false question.
If I prepay my January mortgage payment in December, can I deduct the interest amount this year? And the answer is true. The answer is absolutely true. Now, here's my recommendation, is to make that payment early enough to where it gets on your Form 1098, which is sent to you by your mortgage company in late January. So pay it maybe by December 20th or so that it gets into that statement. Some of you may be thinking, well, what if I prepay 5 or 6 mortgage payments? No, you just can do one, because those other interest payments, you don't get to deduct them until that period actually occurs. So that'll be next year.
So Al, let's talk about this. Why would someone want to do that?
Well, the reason is because if they have a high income tax year this year compared to, say, next year.
So let's say I had a bonus, maybe I had some restricted shares or stock options, and then so I have a larger, or maybe I did a Roth IRA conversion or something like that, and I want to create more deductions to shelter some of that income.
Yeah, so the idea is your income is higher this year, so you want an extra mortgage payment to try to get that income a little bit lower.
There's other strategies that they can do too, like maybe prepaying tax, state tax.
Yeah, that's exactly right, and that's what a lot of people do, is prepay that state tax. But be careful of that one, because if you're subject to alternative minimum tax, then it's not deductible. So alternative minimum tax, that's we could do a whole other show on that, but that's an independent way of computing income taxes. And for those of you that have high enough income and are subject to that tax, don't prepay your state tax, don't prepay your property tax statement, because it's not going to help you. It's not going to be a deduction. But in either case, whether you're regular taxes or alternative taxes, that extra mortgage payment will help.
So if I make the actual mortgage payment, or if I prepay my state taxes, so I'm bunching that up in this year, and then next year I'm losing that deduction the following year. So if I even have higher income the following year, then I kind of blew myself up. So you got to be careful with what kind of planning you're doing.
You do have to be careful about that. So let's talk about things that actually cause a little bit bigger deduction, and this is more of a permanent deduction. And so I want to focus on those that are self-employed or that have a business. And when you're self-employed, there's different kinds of pension plans that you can set up, and they're pretty cool. Most of them have to be set up by December 31st, so that's the key. And here you go. Solo 401k, profit sharing plan, or defined benefit plan all have to be set up by December 31st. So in that 401k, this is when you have a company, sole proprietorship, and you have no employees. If you have employees and you want to set up a regular 401k, you had to do that earlier. You had to do that by October 1st. As far as a profit sharing plan, if you have employees, that's a good way to go. Defined contribution, that's what that is. And a defined benefit plan, for those of you that make a lot of money, this might be a good plan, because you can sometimes put a couple $100,000 or more away.
Now, this is really important, because let's say if I'm self-employed, all right, so most people that Al and I see, we've been doing this for many years, have set up maybe a SEP, a self-employment pension plan, SEP, all right, and then looking at that plan, there's only so much that you can contribute to that plan. A solo 401k, you could put dollar for dollar in, so you can put in $23,000 and have a profit sharing component on top of that. We're big fans of the solo 401k if you're a sole proprietor, because you can put more money into those plans, a maximum of now, what, $52,000, $51,000 that you can shelter from taxes. The problem is you have to get that plan done right now. You have to get it done before the end of the year. So look at that. If you're self-employed and you have been contributing to a SEP plan, you might want to consider a solo 401k plan and get this done right now. Now, If you do not have that set up, and then you can also set up that SEP plan all the way up until next year. So if you don't have the time to get it done, you have until next year. But we're not telling you to procrastinate. Do it right now. Here's another thing that I want you to do. Al and I have been teaching a retirement tax planning course for the last several years.
Seems like 20 years.
It seems like 30 years. Every year, it's the end of year tax planning workshop. It is December 3rd. It's 10 a.m. to 12 noon. It is absolutely free of cost. What we try to do is give you last minute tax tips to save you tens, if not hundreds of thousands of dollars long term on your overall tax bill. It's entertaining, it's fun, but it's jammed full of information. So I encourage you to go to puretaxclass.com, puretaxclass.com. Absolutely do that. Register. It will fill up. We usually get anywhere from 400 to 500 people. We fill it to capacity every single year. It's a lot of fun, but even more importantly, there's so many things that you want to make sure that you do before year end. And so we do it right in December. You still have a few weeks to get all the last tax tips in for the year. So join us in December.
Yeah, absolutely. So let's get into the next tax tip. And this is one that is going to apply to you if you've sold stock or real estate at a gain. And in that particular case, you'll have to pay capital gains tax on that. And there's a special strategy that allows you to reduce your income taxes, your capital gain taxes, by looking at other positions. If you have a loss position in a stock account, you can actually sell that stock and create a loss. And this is actually so important, and a lot of people miss this. I think we're going to demonstrate that, Joe. I think you're going to be on board.
Well, I mean, the concept is called tax loss harvesting, and there's so much confusion when it comes to this. Let me just draw this out real quick, because here's what the market does, right? It goes up and it goes like that. It goes up, it goes down, but it trends up. So what we look at is that in areas where the market is down, okay, so here's an opportunity. Now, these assets have to be outside of your retirement account. It has to be a capital asset. So any asset, mutual fund, stock, bond, anything that is held outside of your retirement account that is subject to a capital gains tax. We want you to sell the position when the market is down, but we don't want you to sell and go into cash. We want you to sell and buy something similar. You're selling mutual fund A, you're buying mutual fund B. For instance, let's say I had $200,000 in my portfolio and it dropped to $150,000 just for S&Gs, right? Now I'm down 50 grand. What I can do here is I can sell that mutual fund, okay, and buy something very similar. I don't want to sell and go into cash because it will take me forever to recoup. I still want to be in the market. So I sell mutual fund A, buy mutual fund B. What happens there is that I have a $50,000 now capital loss that sits on my Schedule D. That loss will offset any gain dollar for dollar. I'm not telling you to buy really bad investments, but if I go back in time to 2011, 2011 was a very volatile year. But the S&P, if you go back, it was dead flat. So if you fell asleep, right, you didn't lose any money, but a lot of people lost a lot of money because of the volatility. So here's what happened. Let's say that I had $100,000 invested, right, Jan 1 of 2011. Well, in the beginning of the year, the market was up about 6%. But if you remember, we had the debt ceiling. The S&P downgraded the Treasury. We had a tsunami that blew up Japan. And what happened was the market free-felled, right? But then it rebounded and it ended up dead flat. So if you look at dividends, you were actually up 2%. So at the end of the year, you still had 100 grand. But here's what we would take a look at. In this area here, okay, the S&P dropped 20%. So your $100,000 is now worth $80,000. Okay, so you're down 20,000 bucks. We would say sell mutual fund A, buy mutual fund B. Still be in the market, right? We still want you to be in the market. Now, by doing that, I just created a $20,000 capital loss that sits on my tax return. But I'm still in the market, remember, and the market recovered, and at the end of the year, I still have the $100,000. But what I did is I harvest this loss when the market goes volatile. Okay, so now this $20,000 is available for me to offset any gains, any future gain that I have in a stock, bond, mutual fund that is outside of retirement. Now I can create tax-free income with this. It's so powerful. Join us at our tax planning course. We're going to talk a lot more about these strategies. It's coming up December 3rd, 10 a.m., 12 noon at the Mission Valley Sheraton. 888-994-6257. That is the number. Or you can call 855-99-TAXES. That's a little snazzier number. 855-99-TAXES. We're going to take a break. Don't go anywhere. Show's called Your Money, Your Wealth.
This week's question is, what are the tax implications of annuities? Annuities have become more commonplace in recent years. However, many people purchasing annuities are not aware of the tax implications of this type of investment. Today, we're going to take a look at how annuities are taxed in comparison to other types of investments. First, let's take a look at the two primary ways investment gains on non-retirement investments can be taxed. The first is ordinary income tax. This is the highest of all tax rates and can be as high as 39.6%. The second is capital gains tax. This rate is 15% for most people. However, those in lower tax brackets will pay 0%, while those in higher tax brackets will pay 20%. Capital gains tax applies to gains on certain types of investments that are held for at least 1 year. Next, let's take a look at the rules for annuity withdrawals. If I invest $100,000 in an annuity and it's now worth $150,000, I'm not able to withdraw my initial $100,000 investment until I withdraw and pay taxes on the $50,000 gain. This fact in itself will give you a lot less control over your tax liability and your cash flow. Compounding this problem is that all of the gains on the annuity will come out taxed as ordinary income, again, the highest of tax rates. Often, if you had had the same or similar investments held outside of the annuity, say in a regular brokerage account, for example, you would have paid the lower long-term capital gains tax rate, which is typically 10 to 15% lower than the ordinary income tax rate. Annuities also have considerable tax disadvantages for your beneficiaries. Many investments will receive a full step-up in basis upon your death. What this means, for example, is that if you purchase a stock or a mutual fund for $100,000, and when your beneficiaries inherit the investment, it's worth $150,000, they would pay no tax at all on that $50,000 gain. However, if this same investment were an annuity, they would not only owe taxes on the $50,000 gain, but it would be taxed at their ordinary income tax rate, which again is the highest of all tax rates.